where we saw the US and Canada kind of mirroring each other as they dropped down in the last few months, do you think that does that correlate with the Inflation Reduction Act bill that was passed?
No, I don't think Inflation Reduction Act is, I know why it was called that, but the inflation reduction stuff in there is more likely to be long-term and small. But over time, it could have an effect, and it's just going to be hard to measure it. For example, it's really mostly an environmental bill, as I understood it. And if carbon emissions are much lower because of that bill than they would be otherwise, then costs of all these natural disasters and health outcomes and all this other stuff will be cheaper. It's just going to be harder to prove that it was because of the IRA, the Inflation Reduction Act, that happened. But if emissions are a lot lower than otherwise, and if the best analysis we have is that it was because of IRA, then you can say that there's been some probably significant cost and health benefits to it.
Okay.
But the big increase in prices in the first half of last year was oil and food after Russia invaded Ukraine. And then since June, when gas prices in the U.S. peaked at over $5 a gallon on average nationwide, higher here in Chicago area, it's been coming down. So, that's where the gas prices have been coming down, and inflation's been coming down because the gas prices coming down.
I mean, one thing we just have to, I don't want to say watch for it, but it's possible, is if the gas prices start ramping back up again and you get something like this, and it happens before shelter goes away, you could see another surge of inflation, which will cause a lot of drama until those things go back. So yeah, let's hope that doesn't happen. We'll see. All right. Again, keep asking questions and stop me, because when I'm presenting, I can't see anybody raising their hand. So just speak up. And we'll pause. So this is inflation. Again, we're going to get the inflation reading tomorrow. And these are wages. And if you go back to right before the pandemic, so February of 2020, when that was sort of the peak of the Trump economy, this was before the pandemic hit, wages have actually grown faster than the CPI all and much faster than the CPI core. So what that means is that theoretically, at least, we have more purchasing power now on average than you had in 20, which was considered by all, especially Republicans, to be a wonderful economy. It was an excellent economy. We have more purchasing power now. It's a carefully guarded secret. Only people that come to this call know it. But it's because you don't hear the media talking about it. They like to compare versus a year ago, and I'll show you a slide on that. But we have more purchasing power on average than in 20, which is amazing, considering the amount of negativity. There's often the sort of media narrative is, great labor market. Look at how low unemployment is. Look at the job creation, but inflation. And I say, but wages. Wages have grown more. And, I'll show you some net worth slides too. Net worth is doing quite well as also, which is part of why we may have inflation, because people are doing great. This is just real wages, which is wages adjusted for inflation. So it's this math here, just showing alone, just the wages minus the inflation, just showing what's going on from a dollar perspective. So what are, in 2022 dollars, actually in February 23 dollars, what were wages going backward? And this goes back about 5 years. And you can see they're higher than they were in 2019. At the end of 2019, the person was making $27.80 an hour on average in today's dollars, and now they're at $28.42. So real wages are up. And part of this big spike here was sort of a statistical aberration where a lot of lower wage people lost their jobs. So the average wage jumped. And so what you're hearing a lot of in the media is, oh my, look at how real wages are falling. And it's like, really? That's the best analysis you can do? Because a better way to say it is real wages are higher than 2019, and that's a win. So you heard it here first. Now, this was an interesting analysis in the Washington Post, and anybody that's interested in how the media has covered this economy should read this article. It's referenced down here. The article was titled, "Why Americans Are So Pessimistic About Their Finances," and it says, after taxes, the picture was even worse for poor families, and they're presenting a graphic that shows that somewhere in about 90% of Americans had income gains bigger than spending. during 2022. Let me say that again. This is households with income under 20,000 are pretty rare. It's a household. And when the CBO, and this data is from 2019, this is where the cutoff is for the bottom 20%, meaning you're at the 20th percentile. You're in that next group. You're at the bottom of the next group up at 26,000 with a one-person household. And you were 37,000, two-person household, et cetera. Granted, these are pre-tax figures.
And pre-benefit figures.
But they also are 2019, but they are not adjusted for inflation, meaning that, in other words, these numbers aren't far off when you adjust for taxes and inflation. These numbers are probably a pretty good measure. So under 20,000 is like maybe 10% of the population, maybe 15, it's maybe 5. It's less than the top 20, it's less than 20% of the population. And so the red line spending is pretty much the same in here. And then the green line starts to take over and be higher as you get into that. Anything above 40,000, you're either same or better off. And if you're down in here, you barely had any impact here, and you're hurting if you're under 20,000. So here's a graph showing, 10% of the population, maybe 15% is suffering. The other 85% are better off, and all this doom and gloom. Oh, it's, Americans are so pessimistic about their finances. Americans are pessimistic about their finances because the media is telling them to be pessimistic. And if you are in this lower end here, you have a reason to be pessimistic, but the other 85% of the population has no reason to be pessimistic about their finances. They had a good year. Now, you can always go back to, the argument of income inequality and Americans should be doing better, and, healthcare and college should be cheaper. I mean, I'm not denying that. I'm simply saying income is growing as fast as spending for the vast majority of the population after taxes. And if you look at this pre-taxes, I don't have it in here, it's an even better story. It's just like this last group down here was that lowest under 20K group was the one that's negative. Everybody else was positive. So the after tax, making it after taxes really just moves the dial here with this group a little bit. So
my other comment is that these are not including benefits. So not including food stamps, Medicaid, child credits, and all the other benefits that people had that added to their income in 2022, but especially in 2022. So
there are groups that are hurting, no doubt, but this way of measuring it from the Washington Post and saying, even by our sort of negative way of measuring things, 80% of the population is doing better than they were in 2021. They're still saying, why does the economy stink? And you got to watch for that lingo. I see it in the New York Times too. They'll spend 2 paragraphs talking about how great the labor market is, and then the rest of it talking about how much inflation's killing everybody. And it's like, why don't you show this?
What is very interesting about this is if you're working 40 hours a week and you're earning $10 an hour, you would be at 20,000 or above. If you're making $15 an hour and you're working 40 hours a week, let's say at McDonald's, which is about what they're paying these days, you would be at $30-some thousand. So that's an interesting point.
I mean, understand this is sort of it's just be aware of all this negativity out there and push back on it, because this is a really excellent economy. I mean, this real wage, I shared this slide in the last presentation. We don't have it in this one, but of all the presidents going back to 1964, so back to Lyndon Johnson, Biden has the highest average real wage of any of them. Meaning if you average Biden, he came in January, so he's 2021. So if you average this, you can see just eyeballing it how much higher it is than what Trump had. He didn't have this big spike for very long. So if you average going back into the Trump presidency for 4 years versus Biden's 2 years in here, Biden is much higher. And Biden's higher than Trump, who's second. And then he's higher than these other ones. And again, it's adjusted for inflation. One of the funny things in there is that Carter was $2 an hour higher than Reagan. Despite inflation, wages grew very well under Carter, and he had higher real wages than Reagan. So it's just people, the media is talking about, oh my goodness, real wages are coming down. It's like, well, this never made much sense. This was a statistical issue that is resolving itself. And really, if you do a fair comparison of Biden versus Trump, Biden comes out ahead. And, it's again, I call it a carefully guarded secret, the real wage story. Think of it this way, as if you just talk about the budget deficit as spending and not about revenue, then you're obviously having a biased discussion. You need to talk about the deficit. You need to talk about revenue. And the same thing when you talk about inflation, you got to talk about wages. And if you see discussion of inflation that has nothing, it is not in the context of real wages, they're missing it. And it's, maybe the media guys want to do it to get eyeballs to click on it because, bad news sells. But it's really good news. The real wages are in fantastic shape. They're very high historically, very close to the all-time record. I don't have the long-term chart here, but the record is right around the same height as this point. And you go back to like 1948 or something. I think maybe this measure goes into the 60s. It's in the 1960s. The measure is at like the 95th or 6th percentile. I mean, it's higher than 95% of the real wage readings going back for the entire history of this data series. I mean, it's the real wages are very high right now, and that means purchasing power is very good. All right, I've hit that drum 100 times. All right, so I hate to break the news to you, but now we're going to talk about banking. And so if you start falling asleep, stand up, shake it out a little bit. But this will talk to you about this crisis that we just had and kind of some of the lingo that was used and maybe help explain kind of what's going on. So bear with me because this stuff is a little dry, but it's not very long. We're just doing a quick synopsis. So here is Silicon Valley Bank diagram of what's called their balance sheet. So a balance sheet is one of those things that accountants put together that tell you what a company owns. Those are the assets, like cash, investment securities, loans to customers, mortgages. Those are assets for the bank. People think of a mortgage as a liability. They owe it, but they owe it to the bank. The bank has the asset. And on the other side, you've got their liabilities, what the bank owes, what is owed to others. The bank, in theory, has to pay deposits back. If a depositor wants their money, they got to give it to them. So that's a bank liability. And then if the bank has issued a bond to get money, it's a Silicon Valley Bank bond, then that would also be a liability of the bank because it owes those funds to the bondholders. And so the difference between the assets, and these are in millions, so this is $211 billion, $212 billion. The difference between assets and liabilities is, by definition, the equity. That's the math. Equity equals assets minus liabilities, and it's like 16.3 billion or so. That's the green bar. So, and this is, by the way, is not an unusual amount of equity for a bank to have. And I've got the ratios down here that show you the math, but you can divide the assets by equity. So 211 divided by 16 gives you a ratio of 13. And a handy trick here is if you divide 100 by the leverage ratio, that tells you how much of a drop in this asset price it takes to wipe out that equity, meaning to bring the blue bar down to the same height as the red bar so that the equity becomes zero. And negative equity is called insolvency, meaning you don't have any, you have no equity. And you can see that banks, this is not unusual, like JP Morgan Chase had a very similar 12.7% leverage ratio or 12.7 leverage ratio. And that wasn't the crazy thing about Silicon Valley Bank. So what was happening with them is they had bought a lot of bonds. When they got deposits, they would buy bonds with them, and the price of those bonds had fallen. So even though it showed up here at the end of 2022 as having equity, what happened is this blue bar, if you use the market value of those bonds, had fallen because the Federal Reserve had raised interest rates. And remember, asset prices and interest rates move in opposite directions. So when the Federal Reserve is raising interest rates, the price of bonds that are having, let's say, a 2% coupon, paying a 2% interest rate, those fall a lot in value. And so if you were to look at the market value of this blue bar, it might have been down here in the 170, 180 range, meaning the bank was insolvent. Now, a lot of banks are in that situation right now. Big banks have lost a lot of money on their bonds. If they haven't sold them, they're fine. They can hang on to those bonds until they mature and get their face value. But right now what's happened is those prices are down because interest rates are up. And this caused people, among other things, Silicon Valley Bank depositors for whatever reason, decided to leave. A lot of them were larger businesses that had hundreds of millions of dollars with Silicon Valley Bank, and they wanted to take their money out. And so you had a classic bank run where Silicon Valley tried to sell some of these assets that they had, even though they were down in price. They did that. They reported an almost $2 billion loss. And there was sort of a panic where people started taking their money out, and they had a bank run and they got shut down. And it happened over like a 2 or 3 day period. So the point I want to make is banks don't have a lot of equity generally. This is usually fairly typical. What was a little, and also because the Fed has been raising interest rates, this blue bar, if you really measure it, has fallen from a market value perspective. Banks are sort of kind of insolvent, and but you know, there's nobody panic at these other banks. They were panicking here. And so there's an investigation going on about was there a panic at Silicon Valley? Was it because they announced that they sold bonds? Were there people inside the organization telling people to watch out? You know, it's just, there was a bank run, and no bank can really survive it. When it gets going, enough momentum, they get shut down, and the rest is history. So this is what's called a bank balance sheet. Just wanted to get you familiar with kind of what's in a bank balance sheet. This is the summary version. Here's the actual detail. This is a bank balance sheet, literally. This is the Silicon Valley Bank balance sheet. And so you can see some of these numbers like cash, 14 billion. Again, you'd have to add 6 zeros at the end of this. Cash in the vault is sort of, that's what this means. Down here is a sum of all their investments, like 130 billion worth of corporate bonds and government bonds that they own. They've got loans to customers as another asset. That would be like the mortgages. And then they have their total assets here. So here's 211,793. That's this number right here. 211,793. And then when you go into the liabilities, they got a bunch of liabilities, but the big one being deposits. And they've got lines of credit that they use to, you know, if they're buying stuff, supplies, whatever else, they may borrow on a short-term line of credit to use that for funds. And then they had issued some bonds to the world to help finance them. But most of this, the 170 billion of the 195 is deposits. And that's the biggest part of this red bar here. So there's 195, 498, there's 195, 498. And we didn't say it, but Carl and I are both CPAs. So this is our world. We live in balance sheets and income statements, but here's the summary, here's the detail, FYI. This is what a balance sheet is. And
I'm remembering life 30 years ago from I worked for, did some work for the Resolution Trust Corporation. We had all the bank and S&L failures back in the late 80s.
So yeah, if you didn't know about balance sheets, here's a guided tour of what one is now. There's an interesting thing on here. And I'll be honest, I don't know enough about this industry. I never worked in banking to know exactly what this means, but it looks like when you see it, it says held to maturity securities at amortized cost, net of allowance for credit losses, blah, blah, blah. And this one says available for sale securities at fair value. And then, but it says cost amounts. But let's look at this big bucket here, the 91 million. Amortized cost and net of allowance for credit losses, blah, blah. Okay, here, fair value 76 and 97 at these dates. So here it says 91, but they're saying fair value 76. So here you're getting this idea of, assuming that's sort of like the market value after the Fed has raised rates and those prices have fallen, which is probably what it is, but I'm not 100%. But that's where you see this idea that the 211 isn't really 211 anymore. It's something smaller. Here they're saying this 91 is now more like 76. And you know, they went back a year. 98 is more like 97. But really, this is the number, 9176. This is the kind of thing that's scaring people, I think, is the fair value is lower than the book value. And the book value is what's here on the balance sheet. Sorry to get technical on you. This is CPA nerding out a little bit, but this is kind of what's going on the inside of a balance sheet of a bank.
I seem to recall that about 2 weeks before the bank failed, these financial statements were actually published by the accounting firm. I remember the exact date.
That's fair. There's usually a lag. You know, if the statement is as of 12/31/22, it's probably going to come out in March. Yeah.
I think that's what happened, and that may have been why all of a sudden people looked at that line that said the fair value was 76.
Right.
Billion, and you know, okay,
now another thing I should add is that if the bank had taken the deposits and bought shorter term bonds, like let's say a year or two or a year or three, as opposed to maybe they did more 5 and 10 year bonds, those shorter term bonds have taken less of a hit. And so what Silicon Valley Bank may have done is bought a lot more of longer term bonds. And the reason they did it because longer term bonds offer a higher coupon or a higher interest rate. And they got caught because when the Fed raised rates, that's where the big drop in price is. So we'll know that when they do the full investigation and report out on it. But I suspect that if we analyze a ratio like this 76 divided by 91, if we were to go and look at other banks, and assuming they have the same disclosure, you would think that this number would be closer to that one. And if they had done a better job of taking less risk and had bought short-term bonds as opposed to longer-term bonds. The longer-term bonds are more sensitive to movement in interest rates by the Fed. So that's kind of the story. This is pretty darn technical. So if you've kept up with this, great. Understand that you can always, I always say if it doesn't make sense, you can always ask me or Carl questions today or through email in the next couple of weeks. We can give you more information, but you can also continue to read this or dig into it as you see fit. But this is sort of a tour of a bank balance sheet. There's the summary picture, there's the detail, and you can see some of the numbers and what's happened kind of in that fair value note right
I wonder if the government will go after the public accounting firms again.
Never know. I'm curious to see that too, is usually they go after the public firm if these numbers, like these book numbers, are wrong. Like if this is, in other words, if this data is accurate, then the public accounting firm usually has, and you know this well, Carl, too, they usually have a pretty good defense. Where they get into trouble is if they violated what are called generally accepted accounting principles, where maybe this fair value should have been 50 and they reported it at 76 and didn't stop management from doing that. Then you're going to see the accounting firm get blasted. I suspect the people that are going to get hit the hardest, and it's not necessarily breaking the law, is the risk managers within Silicon Valley Bank that said, don't worry about the Fed, go ahead and buy those long-term bonds. They're the ones that are they're going to take a hit. And that's not necessarily they're going to go to jail. It's just that they're going to carry that stain on their reputation when they go to the next company and say, I was the risk management guy at Silicon Valley Bank. They'll be like, whoa, maybe. Hopefully you've learned from your errors, so, never know. But that's where I think it's going to fall on what they say, bad risk management. Management did a bad job of managing risk, but I don't know that that's illegal or that it means that the auditors did a bad job.
I would agree with you on that standpoint. But if you're looking for a deep pocket.
Oh, you're right in that they'll get sued, no doubt.
And I would argue, not having been an auditor, and looked at this for 30 years, I would argue that the auditor should have flagged the fact that there was a $15 billion potential markdown on the asset side and only $13 billion of equity, and said, this is this a going concern? Is this a concern that this is not a going concern at that point? And that's where I think that the public accounting firm may get faulted.
That's right. No, that's fair. They have
even if the math is accurate, and I know that I know that 30 years ago, if you weren't trading the treasury bonds, but were just buy and hold, you were allowed to hold them at cost. Back in the 80s and 90s, and that's what it looks like they did. But there's still a risk here, and they didn't hedge that risk, and they didn't flag that risk.
Yes, I thought there was they said something about that larger banks were required to buy some kind of like a security futures contract against interest rate changes that would pay off if interest rates went up. They would get some of their money back, and the smaller banks didn't have to do that. And the problem was they got Trump to change the law so that even they could get bigger and not be subject to them having to hedge their risk. And they didn't hedge their risk, and that's why they got caught.
Yeah, I don't fully understand this. I'll have to see if I want to go back and unretire and go look into.
All right. So some interesting things going on. The question is, how are other banks doing? And there's some interesting ways of trying to get at that question of kind of what are other banks doing to make sure that they're not subject to a run. Part of what Silicon Valley Bank did, remember, there was they sold some of their assets and they reported a loss. They sold like 20 billion of them and reported a loss of like 1.8 billion. And that was part of what scared people. So rather than be forcing banks to sell their bonds at these depressed prices, the Fed is saying, borrow from us. We'll give you money and we'll lend to you. They don't give it, they lend it against collateral. So let me explain the two programs. The discount window's been around forever, and the bank will just say, I got these bonds and I want to borrow money against those bonds. And the discount window historically has let you borrow, but at market price, meaning if your bond is worth 80 cents on the dollar, they'll let you borrow 80 cents against that bond. Whenever the word gets out that a bank is borrowing from the discount window, there's a stigma, fear of bank instability. Like, why are they doing that? And they use the word discount window. Why are you using the disco? And so what the Fed has done is they don't identify borrowers, and they don't identify until after a 2-year delay. Borrowing is very high, is below peak, but still very elevated versus sort of this before this happened, before March when this started happening. So the borrowing level was less than 5 billion on 3/8. It went to 153 billion by 3/15, and now it's back to it was down at 110 as of 3/22. I haven't updated this lately or since then, but so there's a lot more going on at the discount window. Banks are borrowing money, so they've got cash ready in case somebody they have against, I guess I would say they have some cushion or a shield against a bank run by having more money handy. And they were able to do that without having to sell. Like Silicon Valley Bank could have done probably more of this, and perhaps they didn't do as much as they should have. They chose to sell assets, and that in hindsight may have been a big mistake. Maybe they should have done a lot more of this. The bank term funding program is a brand new program, and this is where the Fed is lending against same kind of stuff, but they are valuing the collateral at the original or par value, meaning even if the asset's at 80 cents on the dollar, they're lending at $1. They're lending at 100. It's up to a 1-year loan. It's brand new, so there was 12 billion on 3/15 and 54 billion on 3/22. So banks are definitely taking advantage of it. Now keep in mind, some of the large banks like JP Morgan, they have like 3 trillion in assets, just that one bank. And so when you look at these numbers, they're big. This one jumped and peaked. This one is new. This is not a huge amount of money in terms of the banking system. Now, could this be very meaningful money for some smaller banks that are worried about a run? Sure. But like a JP Morgan, this isn't huge money to them. For 3 trillion is 3,000 billion, right? So this is not JP Morgan doing all this. This is a lot of, and I don't know all the details of the distribution, but it's not the big banks that are taking the lion's share of this. It's smaller banks that need the money and are borrowing against it. So again, Silicon Valley Bank felt compelled to sell assets at a depressed price and tell the world that they did it, and took a big loss on it, which scared people. The Fed is saying, don't do that. Borrow from the discount window. We got this new term funding program. Use it. And I don't know I don't know how big the delay is on the bank term funding program, but I'm pretty sure it's secret who's doing it right now. They're not saying who it is. I don't know if it's 2 years or if they've decided how far out that is, but it is, this funding is there, and it seems to have handled. There's no, as far as we can tell, there doesn't seem to be a systemic crisis going on where interest rates are going haywire or inflation's going haywire, or you're seeing other banks being shut down. And it seems like this got it under control. We'll see. But the Fed, they did not waste any time. As soon as this happened, they put this stuff out there. It's too bad that the bank regulators that were at SVB when these discussions came up, maybe they could have said, maybe they tried and said, perhaps you could use the discount window, and the bank people said, we don't want to do that. Maybe they thought that there wouldn't be a bank run, but there was on that bank. Any questions on these facilities? All right. This is just the details of where these numbers come from. There was an interesting New York Times article it was New York Times, yeah. And there was another one in the Federal Reserve Bank in New York, but they explain where these numbers are. So like primary credit is the discount window. That's the 110 right here, is right here. And the bank term funding program, 54-ish billion. That's this 54 billion right here. There it is. So that just gives you, if you want to find this, it's the H41 release. Don't know why you would, but if you're curious, if these numbers are going up and down, that's how you spot them. All right, any questions on banking system? Again, we just wanted to hit it quickly tonight. Now, I'm not trying to teach you all things about the bank. Plus, I'm not a banking expert, so I usually learn by fire. When some crisis happens, I start reading and I see stuff like this.
Now, some banks get together and they trade off their accounts. so that no one bank in the group has more than the FDIC insured amount. That doesn't really change anything, does it? It just means that there'll be less likely to be a bank run because nobody's afraid of losing their funds.
Yeah, I mean, if the bank has, if people know that banks have access to these funds and aren't forced into selling their assets, then there's no panic, right? No reason to.
Well, I mean, there's still the same risk overall from the group of banks. You know, if all the banks together can still lose their assets and still go insolvent, because that, you know, the net is the same across all the group of banks. But the difference is that the reason people pulled out Silicon Valley is because they had accounts over the FDIC insured amount. So if the bank went insolvent, they could lose their money and there'd be no redress. When they have these groups of banks getting together, it doesn't matter if they go insolvent, you'll still get your money back because only 250,000 was in each bank in that group. So all it does is it reduces the chance of a bank run. It doesn't really change the actual solvency and solvency for the banks as a whole, correct?
Yeah, and you're right. I think the Silicon Valley Bank, I don't remember the exact number, but I remember reading that much greater percentage of their deposits were over that, were not insured, they were over that limit. But other banks have a lot of that issue too. I mean, almost any business, any good-sized business that is banking is going to have a lot more than $250,000 sitting there. Like, for example, you've probably heard of Roku, the company. You may own a Roku. It's like one of the streaming, it's a box that you can use to stream on as opposed to your cable box. And they had $400 million with Silicon Valley Bank. I mean, I did the math for fun. I don't have it here in front of me, but it was like they'd have to have thousands of accounts to have all that under 250,000. So for an individual, the vast majority of individuals, they have 250,000 sitting in a bank account, but it's businesses that have the big money. And the government chose to step in and say, we're not going to let you take losses. They wanted to not, they know that a lot of these banks are insolvent or they're much, that cushion here is very thin. If it's not negative, they are aware of it and have said, at least in this case, we're going to hold depositors whole. The Washington Post was said, why doesn't the Fed come out and either guarantee them all or say they're not? They kind of wanted the Fed to take a position. I think the Fed is being very smart in saying, they said, we took action. It seems to have solved the problem. We're prepared to take more action if we need to. I think that's prudent, but we'll see. Again, these things come out of nowhere. Like if someone had said to me, we weren't talking about a risk of a Silicon Valley bank imploding in our February presentation. This all happened in the beginning of March and was over in like 4 days. You know, I mean, this stuff comes out of nowhere. And it just, the world is just, things move fast. I mean, really fast. All right. Okay, let's talk about there's some really good news in this section too. So this is the latest Federal Reserve forecast from March of this, just a few weeks ago. And they didn't change it very much, but they did lower, this was the kind of the big change right here. They lowered the growth in 2024 a fair amount, but almost all these other numbers are like the same or like 0.1 different from what would have been their December forecast. They do this quarterly. And the long run stuff didn't change. So this was all they said, as things will probably be worse in 2024 than they thought, and they're not changing 2023 very much. Unemployment rate's pretty much the same. They're just, again, it just was this number right here. Not much else changed. Now, what the Fed looks at investor inflation expectations. This comes from a calculation of, it's the difference in interest rate between an inflation protected bond and the same just plain old bond of the same maturity and type treasury security. What this is saying is whether you're looking at 5 years out or 10 years, that's these red and blue lines, 10-year break even, 5-year break even. Break even rate is the difference in the interest rate between the inflation protected and the non. They're both about 2.3. So the investors are saying, we think inflation is going to be about 2.3% over the next 5 and 10-year range. So the Fed is looking at that saying, we're glad this has been more or less flat for the last, no, it's been coming down from this peak and it's been flat for a while, but they still want to move it down a little bit. So they've been continuing to raise interest rates. Fed funds rate is the short-term rate that banks lend to each other, and that's at 4.8. And we'll see if this goes down. It looks like it crept up a little bit during this scare. There was a little bit of a move here probably in March when the banking issue came up, but it's come down since, and it's back to this sort of 2-3 range. It's sort of been trickling in that range for a while now. So this is good news, but the Fed would like that it's not going up, but the Fed would like to see it down below 2. This is a prediction of interest rates based on that kind of analysis that I just showed you, kind of these differences in interest rates. The prediction is that a year from now, that we would go into recession. There's about a 57 or 58% chance of recession in the next year, 12 months out. And it's up from about 25% in August. And in January, it was 57.1, so it's a little higher than January. But it's not a crazy, I should say, it's not crazy. It hasn't gone up very much since January. I think it actually came down just a hair from February, but I have to look at that. But this is their latest estimate of the chance. You can see it's high. This black line is higher now. It's higher than these. It's the higher than it's been going all the way back to wasn't even this high going into the Great Recession. The interest rates are kind of funky right now with the differences between the low and the longer term. And they're thinking that that's a sign of a recession or the possible recession. So we will see. What I've said before is that it's hard to beat 3.5% unemployment. And when you think of recession, the technical definition is a variety of definitions, but it's a peak. And the powers that be, the NBER, National Bureau of Economic, what is the R? Research, National Bureau, some economists there will say eventually we had a peak at some point and now we're in a trough, or we're not at peak anymore, we're in a downturn. Again, it's hard to beat 3.5 unemployment. You're not going to get to 3 unless something miraculous happens. It's more likely that it's going to go toward 4 and 4.5. And if you're getting into that range, then you can clearly say we had a peak. And Carl's pointed out, I think before too, if you're going to see job creation go towards 0 or negative, then you know kind of that you're in a recession. If unemployment jumps into the 4s and the job creation goes towards 0, chances are you're in a recession. But that has not happened yet.
Adding 236,000 jobs last month is not a recession.
That's very solid. Clinton has the record for the most jobs created in total, I think, during a presidency. And he was, I think wasn't his job creation in that range? Well, where were we? Was it like 230 something, 220?
1,000 jobs a month, I think, your chart. So
it's job creation the last month under Biden was like the average of the best job creating president over 8 years we ever had, and a little bit below the best job creating president we ever had, which was Carter for 4 years. So Carter was in the mid 200s too, right? 240, 250?
No, Carter was like 215.
215,
so
okay.
Clinton was actually higher.
Clinton was higher, okay. So he had the biggest percent. Carter was the one with the biggest percent increase during his 4 years. Clinton had faster numbers. Fair enough. That's right. Point being, very good job creation. Unemployment rate extremely low. Until you see that unemployment rate start creeping up into the 4s, you're probably fine. And the job creation going towards 0. Some good news in terms of the number of uninsured. Because of and just a little history, we used to have the bars are the number of millions, and then the line is on the right axis, and that's the percent. So the percent uninsured was somewhere in that 18% range back in 2010. And the number of people that were uninsured was like 47, 40, somewhere in there. And then when you put in the ACA, we passed it in, what was it? Did we pass it in 10?
Passed it in 2010, and it really went into effect in 2014.
Right. And so here you see this big drop, and it kept dropping. And then during the Trump years, we had some ACA sabotage going on. He was hurting the program, and he started creeping up. And then in 2020, those pandemic measures kicked in, and they expanded the access to the Affordable Care Act, who could qualify for the subsidies and making the subsidies a little more generous. And that started getting the the uninsured down. And we hit the record low, 27 million uninsured. And I got to be careful with that word. Let's just say, going back to at least what I'm measuring here, but even if you go back to the 1990s, this is very low uninsured, 27 million and 9.9% uninsured under age 65. So this is a great result. And if you look at Trump in 2019, so Trump at his worst, good economy, but bad policy. What's the difference here? It's almost 6 million people, isn't it? 5.8 million more insured now than before the pandemic in 19. That is quite an improvement. and the percent went down as well. So it wasn't just because our population, obviously the population got bigger, you would expect, and it did, you would expect to see more. But great result here. And we have to cover this in a future meeting. There's supposed to be a big hit coming, though, go in the other direction, because some of the pandemic measures that expanded Medicaid are going away.
CARES Act said that in order to get some of the money, you weren't allowed to kick people off of Medicaid during the pandemic. And so you have a number of people that their income or other factors have changed and they're no longer eligible, but they've been kept on Medicaid through the end of the pandemic, which I think, if I read things correctly, Biden signed something this week that the pandemic is over. So
this will start going the other way if we don't do something.
Oh, no, it's going to start going the other way. Well, people are going to have to go ahead. If you get kicked off of Medicaid, first off, we have to make sure that a lot of people who are still eligible don't get kicked off of Medicaid. And those that are no longer eligible need to go ahead and get a policy, a subsidized policy in the exchange, and don't just drop insurance totally. Now, I go back to when Space in the name of our governor right now, but when he ran, one of the things he proposed was a Medicaid public option, because a lot of low-income people vary month to month as to whether or not they qualify for Medicaid. And when they go off Medicaid for a couple of months, they now have a new policy with a big deductible that they're never going to hit, because 2 months later, their income's back down and they're back on Medicaid.
Right.
And if we had a Medicaid public option that was subsidized by premium subsidies, the people would not have that kind of chaos in their healthcare program.
Right.
So we'll have to see whether we can't convince our state legislators to actually implement that.
Okay. So stay tuned on that. I think that's going to be occupying a lot of space in the news at some point. I'm not sure if it's next month, the next few weeks. Maybe it'll be in our next presentation. We'll do an update on it. But we're going to see some impact on people getting kicked off of Medicaid. And I read that and I don't remember the exact number. It was big. It was like 10 or 11, 12 million or some crazy number. If like half of those people are actually eligible for Medicaid, but they may not know that they are and apply for it. I mean, there's going to be a lot of unnecessary hassle that a lot of people have to go through, and it's a shame. Switching to energy for a second, just to be clear about this, I see it a lot on Twitter where Republicans go after Biden, saying he's a negative on American energy, he's damaging our energy independence. The way that energy independence gets defined is by, are you exporting more than you're importing? It doesn't mean that you make all your own oil and you use it and that's that. That's not how it's defined, whether it was under Trump or going back a long ways or now. Energy independence means just that you're exporting more than you're importing. That conceptually you could live on your own product, but it isn't that simple, because stuff gets refined and people use different kinds of energy products that are better handled or made overseas, and so you might ship your crude over there. I mean, there's a lot of international trade aspects to this, but just to be specific about it, this is a chart from the Energy Information Administration, which is the group that does this stuff. And this is the amount of net imports. So you're not energy independent if you are a net importer. And then when you hit this line where it's zero, you become energy independent. And so when you're below this line, you are a net exporter. Your exports are more than your imports. And throughout much of the Biden administration, we've been energy independent. There were a couple months in here where we weren't, but for the most part, we've been energy independent. We have been, and this is actually October. I think I left a note here. Every month since October of 2021, we've been down here. So this is a graph where you want it to go, assuming you want, you're not a clean energy purist. From a energy independence standpoint, we've been energy independent since October 2021, and pretty close to zero since we first got there in 2019 under Trump in September of 2019. And you can see that this trend has been happening for a while. And it started in like 2016. Well, it started back, you can look at it going back, probably goes back before 2012, but it was coming down throughout the early Obama era. Then it kind of flattened, but still was coming down. And then it was going down more toward the end, and it just kept going down throughout the Trump era. And this was predicted in advance. Like, people could see the the shale, the fracking thing coming, and we've been able to become this energy creating country, a net exporter, and so defined as energy independent. So when you hear Republicans say Biden's doing all these terrible things to U.S. production, blah, 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 we're as energy independent as we were under Trump. And you could say more so now, I guess. This is even more negative, more below zero. So for what it's worth. Now, here's one that I know will raise some eyebrows. This always amazes me whenever I look at these statistics. This is for these groups. So top 1%, the top, it's nine, top 10% minus the 1%. So that 90th to 99th group, 50th to 90th, bottom 50. Here's how much net worth a typical household had, the average household had. And so averages by nature are distorted by the highest amount in there. As Carl likes to say, if Bill Gates walks into a room, the mean, if there's a bunch of you in the room, 10 of you in the room, the mean might not change. The median, the person in the middle might not change very much, but the average goes way up. And so the top 1% average is 33 million in the blue. Where are we? Fourth quarter of 2022 is the blue, the dark blue, and the light blue is the fourth quarter of 2019. So this is how much richer are we versus pre-pandemic? And the answer is every group is richer. And you can't really see it very well because it's so small compared to these big guys here, and I did that on purpose. But the percent increase for the bottom 50% has been very large. Where is it? Plus 26,000 or 68% increase. And this is real, meaning adjusted for inflation. So the 2019 numbers and the 2022 numbers are in fourth quarter 2022 dollars. And that kind of tells you, how different in wealth the different groups are, by household, and when you talk about taxing the rich, where's the money? Well, that's where it is. And there's an awful lot of it up there. So these are just some changes over here. And you can see the different groups have all had positive changes since before the pandemic. Everybody's getting richer. It's just the distribution is still pretty skewed toward those richer people. And I think it was, in the last meeting, I think maybe not, I'll look, but there's a table that I do that kind of shows how many dollars are in each group. And you can get a total, not just by number of households, but it'll give you a sense of the money is heavily concentrated in these top two groups. And I think these two groups have about as much money as the 50th to 90th, and then this bottom 50% group has very little. It's like 4 trillion in the bottom 50% and like 135 trillion total across all groups. So the bottom 50% has 4, the upper 50% has 131. So it's very, very skewed, but this is just one way of looking at wealth inequality. All right, so from an action standpoint, we always ask you to share some of this stuff, whether you do it with on Twitter or Facebook or any emailing your friends. You have access to this presentation, you can share it, argue it out with your family members, whatever you do. This is a slide that kind of summarizes a lot of the key statistics for Biden, and it goes through a lot of the records that he's had. And this is sort of a one-stop shop for some of the highlights of his record. So you got lots of good stuff in here, and it's updated. And in a couple of cases, I'm using an older number deliberately, like the 3.6% average in 2022 was the lowest average for a year since 1969. You heard that 1969 statistic when we hit like 3.5%, sort of tied Trump's best. And then when we went to 3.4, we were the best since 1969. But when you look at the average of the 12 months of 2022 averaged 3.6, that's lower than any year going back to 1969. So there are some historical stats in here that aren't going to change month to month. Those are permanent until we get a new year, and we'll see how that looks. This is Carl's favorite slide with some modifications, saying the economy is better in 2022. We've been comparing to 2018 because 2019 was so awesome, but even now, 2022, when you do the averages for 2022, was better in most ways than 2019. So the unemployment rate was lower. More people were working on average. The real, meaning inflation adjusted GDP per person, was higher. This is one that was actually better in 2019, but barely. The employment to population ratio for those prime workers. Real wages higher in 2022. The net worth numbers are much higher. in 2022 on average. And then the stock market was a lot higher in 2022 than 2019 on average. And the uninsured, we shared that, were a lot lower. So 2022, as awesome as 2019 was at the end of a 10-year boom, and then remember the pandemic hit in early 2020, so the 2019 was a great year. 2022 was better on all these measures, and these cover a lot of different things. They cover the jobs market, they cover GDP, they cover wages and inflation. Real wages, meaning that covers the inflation concept, is built in there, and the number of uninsured in the stock market. So a lot of the economy is covered in these basic statistics, and that's an easy slide to share. And then there are just some links to different things that are handy references to have. One of them is this article, and there's a version of it. Where are they? Here's another one. The economy does a lot better under Democrats on every measure, really, and it's under Democratic presidents, and it doesn't depend on the difference moves a little bit depending on whether Democrats or Republicans controlled the Congress, but whether it was Democrats or Republicans controlling the Congress doesn't matter, in that the Democratic president outperformed the Republican president. So it's not a question of the Congress really did it. There is a statistical difference with Democratic presidents in the economy, and these articles and some of the other ones down here talk about that. Here's a Twitter thread you can share. Here's a article from the New York Times, and here's an article in Wikipedia that has lots of different statistics and sources that you can use to make that argument. A lot of people don't know this. Like, the Republicans tend to poll better on handling of the economy. They poll better on, and this was even before the latest and all the media coverage of inflation. You go back, it's just a historical thing. Same with deficits. Because Republicans are always complaining about spending, people think they are better at deficits for some reason. Deficits are actually considerably lower under Democratic presidents. And as we like to say, 10 of the last 11 recessions started under Republican presidents. 10 of the last 11. So take pride in being a Democrat, and the party does great on this. And, I try to make it one of my missions to address that wrong perception that Republicans are where you go when you want a better economy or a lower deficit. And Democrats, we just have to up our game and make sure our people talk about it a lot, and that the media talks about it a lot. So that ends our prepared remarks. I'll stop.